Is the dollar still the place you run when everything else is on fire? Or are the exits getting crowded? That's the question. For a century, the safe haven script has felt automatic. Markets panic, money flees to US dollars, and treasuries, yields drop. Headlines say flight to safety, and everyone breathes. But safe havens aren't magic. They're trust wrapped in plumbing. And trust can shift slowly for years and then all at once. Start with what safe haven really means. It isn't about flags or feelings. It's about where big money can hide without blowing up. You need three things: a deep market that can absorb trillions, rules people believe will be enforced tomorrow, and a currency other people must use whether they like you or not. For decades, the dollar checked all three boxes. The Treasury market became the world's cash park. Wall Street provided liquidity at any hour. Oil priced in dollars forced global demand, and when crises hit, from Asian contagion to dot-com to the great financial crisis, the dollar's network effect pulled money in like gravity. So why even ask if that gravity is weakening? Because patterns we usually see right before a regime shifts are starting to rhyme. The dollar's share of global reserves has drifted down over the last couple of decades. Foreign buyers are a smaller slice of the Treasury market than they used to be. More countries are experimenting with paying each other in something other than dollars, sometimes euros, sometimes yuan, sometimes just local currencies paired through new payment rails. Energy deals that once reflexively defaulted to USD now occasionally don't. None of this flips a switch tomorrow, but it changes the background music investors dance to. Debt and deficits matter too, not in a moralizing way, but in a plumbing way. A safe haven promises you will be paid on time in money that still buys things. If the issuer keeps needing massively more of your savings every year, and the interest to service yesterday's borrowing climbs, the promise gets harder. Markets begin asking for higher yields. Higher yields fix one problem, more willing buyers, by creating another. They raise the hurdle rate for an economy already addicted to cheap money. In that world, risk-free starts to feel more like policy-dependent. The haven is still there, but the price of safety isn't free anymore. There's also something new in the last decade: the weaponization of the pipes. Freezing reserves and payments to punish bad behavior may be geopolitically justified, but it changes how neutral the dollar system feels to everyone else. If you are a finance minister in an emerging economy, your risk model now includes not just inflation and growth, but also sanctions and access. That nudges you to diversify slowly, quietly, but persistently. Safe havens are built on the idea that politics can't reach into your vault. The more people think politics can, the less haven the haven feels. Before we get carried away, remember the other side. Alternatives are not obvious. The euro has depth, but not one fiscal spine. The yuan has a giant economy behind it, but capital controls in front of it. Gold stores value, but doesn't settle trade invoices or pay coupons. Crypto promises independence, then reminds you how fragile independence can be when liquidity vanishes. The dollar's network, contracts, habits, legal precedent, clearing systems, still dwarfs everything else. Even skeptics keep their rainy day fund in the thing they complain about. That tells you the center still holds, just not as effortlessly as it used to. To understand why the safe haven effect persists, look under the hood. The global dollar isn't just the green paper in your wallet, it's the eurodollar system. Dollars created and lent outside the United States, living in bank balance sheets and money market plumbing. When stress hits, every institution with a dollar liability needs dollars at the same time. That creates a dash for cash. Sell what you go, buy what you must, which often means treasuries or overnight dollar funding. That's why we sometimes see a strange dance during crises. The dollar gets stronger even as the US economy looks shaky. It isn't a vote for perfection. It's a margin call. But plumbing can clog. Think about collateral. Treasuries aren't just investments. They're the grease in the global funding machine. Banks pledge them in repo markets to borrow cash overnight. When prices whip around or haircuts rise, the machine seizes, and suddenly even safe assets feel jumpy. We've seen episodes where dealers step back, Volatility spikes, and central banks create backstops or swap lines to keep the pipes open. Each time the system survives, but each time more people notice the scaffolding. A true safe haven is supposed to be boring. When the backstage crew is constantly visible, the audience wonders about the building. Here's another nuance your feed rarely explains. A strong dollar and a safe haven dollar are cousins, not twins. The dollar can surge because the US is genuinely outgrowing everyone else, attracting capital for productive reasons. It can also surge because the world is short dollars and forced to buy them. The first feels like confidence. The second feels like gravity. Both push the index up, but they tell very different stories about future strain. If you only read the headline number, you miss the plot. So how would a fading safe haven show up in real life? Not as a headline that says, it's over. It shows up in basis points and behaviors. Spreads don't compress as much during risk-off. The dollar rallies, but less than the model says it should. Yields fall in panics, but not all the way back, and the rebound to higher yields arrives faster. Cross-border deals routinely price currency hedges into contracts that used to skip them. Central banks diversify the edges of their reserves and hedge what they once held unhedged. Corporates match their borrowing currency to their cash flows more religiously. It's a long, boring erosion until it isn't. History helps keep our feet on the ground. Reserve currencies don't die from one blow. They age out. Portugal passed to Spain, Spain to the Dutch to Britain, Britain to the US, each time for the same reasons. Someone else could move goods faster, finance them cheaper, and enforce rules more predictably. The leader kept leading in many ways long after the currency crown slipped. Britain still mattered after sterling faded. If dollar dominance ever gives way, it will likely look like that. A long twilight, not a midnight crash. There's a geopolitical layer too. The petrodollar wasn't a magic spell. It was a deal that lined up incentives. Energy priced in dollars kept dollar demand high and recycling predictable. As energy trade diversifies, more LNG, more regional pipelines, more long-term contracts written to please multiple partners, the grip can loosen at the margins. Not break, but loosen. In a multipolar world, settlement can fragment, and when settlement fragments, the halo around anyone's safe haven dims a bit. Investors won't throw away the old playbook. They'll just start carrying too. What does any of this mean for you? Not a central bank, not a sovereign fund, just a person trying to protect purchasing power? Think in layers, not bets. Keep some dry powder in the global unit everyone uses when they settle scores. That's still USD. Balance it with assets that don't rely on promises, land, productive businesses, skills that pay in any currency. If you earn or borrow in one currency and invest in another, match your exposures so a surprise FX move doesn't wreck a good plan. If your livelihood depends on cheap credit, ask what happens if cheap is gone for longer than a quarter. Liquidity is a privilege. Treat it like a fire extinguisher, not a decoration. And be realistic about time. Trends in reserve status move in decades, not weeks. What changes in weeks is the price you pay for safety. You may still want the dollar in a panic, but you may have to accept lower real yields or higher volatility on the way. You may still want treasuries as collateral, but you may need to think about term, not just coupon. You may still want to hold cash, but the where of that cash, bank deposit, T-bill, money market, matters more than it did when rates were zero and stability felt free. The better question might be this: does the dollar have to be perfect to remain the safe haven, or just less imperfect than everything else? Right now, it's the latter. The plumbing still works, the court system still matters, the market is still the deepest, but investors are no longer taking any of that on faith. They're checking the pipes, they're building side doors, they're teaching themselves the pattern we always end up teaching on this channel. Trust is a balance sheet line until it isn't. And once people ask, what exactly makes this safe? You're already in the new chapter. If the exits ever do get crowded, the people who fare best won't be the ones who bet the farm on a new reserve overnight. They'll be the ones who kept optionality, the right mix of Q, the right maturities, the right currencies paired with the right liabilities, the right skills that earn across cycles. Safe havens are habits until they are choices. The dollar is still the habit. More people are treating it as a choice. That's not a collapse. That's a warning label. If you found this helpful, stick with money lore. We translate big, messy systems into plain English you can use. So when the herd runs, you know whether to follow the crowd into safety or quietly build your own.